Welcome back to Market on Close. I'm Caroline Woods. Just a few minutes left in the trading day. It's time for the big picture. Let's welcome in Ann Sonders, Chief Investment Strategist, Charles Schwab. Ann, thanks so much for joining us.
Thanks for having me. Nice to be here.
Great to have you. So first, I want to get your take on today's market action, because we're off the highs, but we're also off the lows. We still have 8 minutes left, so anything can really happen. But what do you make of the wild swings we've seen today?
Well, if we close near the unchanged point for the S&P, it would sort of be the epitome of a violently flat day, because we've been all over the place. And I think maybe aside from various headline triggers for the moves up and down, you did have intraday earlier in the day. The weakness in the S&P did bring it into bear market territory, and that followed what was already bear market closing territory on a closing basis for the Nasdaq and the Russell 2000, and that may have triggered some dip buying to step in. But we're so headline driven at this point. Trying to navigate this, even if you're a really adept trader, I think is a very tricky exercise. And I expect this kind of intraday volatility, headline driven volatility, is likely to persist.
So that being said, we were just talking about buying the dip with Scott Bauer. He's not doing that right now. I'm assuming you must get quite a few questions about, is now the time to buy with things on sale? What's your response?
Well, I'm not a trader, so I never recommend trading positions to anybody. My advice is geared toward long-term investors, and the advice has been, panic is never an investing strategy. But maybe also heed, and this is by no means me patting myself or our group on the back for, boy, we called this and we nailed it. We had no idea that this was going to happen. But really what we've been kind of pounding the table on in the last year is what we often do, which is diversification across asset classes, inclusive of international, that be really mindful of not letting concentration risk develop in your own portfolio, especially around things like tech and tech adjacent or the Magnificent Seven. Use rebalancing to force, it forces investors to do a version of buy low, sell high, which is add low, trim high. We've also been really, really factor focused, much more so than any kind of sector biases, because not only have sector volatility been all over the map, correlations in a market backdrop like this go through the roof. So it's hard to find a monolithic sector protector in this kind of backdrop. But factors is what we have been emphasizing for the better part of the last year and a half or so, with an emphasis on high quality factors. And one factor in particular that we added to the factor focus list as we came into this year was low volatility, and that's been one of the best performing factors in this otherwise very volatile backdrop.
Okay. As it relates to tariffs, Ann, we don't know, of course, what's going to happen. It could get worse. President Trump has threatened additional 50% tariffs on China, but I'm seeing the latest headlines. He's saying that tremendous progress is being made with a lot of countries, so it potentially could get better. I'm curious if this is a negotiation, and we do see a deal, say, reached in, deals reached in the next couple of weeks. Is this a stock market downturn, or is this damage that can be undone at this point?
I really don't know, because if you're talking about negotiations, arguably they, based on how the tariffs were unrolled, not to mention the non-tariff related math that went behind it. It was trade deficit related math. I think the question that's being asked everywhere, to which there really isn't a concrete answer yet, is what is the off-ramp? What could those negotiations yield that would right the sort of confidence ship here? And I'm not sure that we're going to get any kind of concrete answer to that. I think we're going to hear from companies very soon about their first quarter earnings. That's backward looking. I'm not sure that's going to matter, but the outlooks, I'm guessing, are going to be somewhat similar to the early part of the pandemic, when companies just basically said, we're not going to try to provide an outlook here with any kind of precision because we have no idea. So I think that's going to be the overarching message that comes in this next key period, which is first quarter reporting season set to start next week.
I was going to ask you about that, if companies might kind of hide behind the uncertainty of tariffs. So in terms of earnings season being a potential catalyst, either to the upside or downside for this market, what do you think? Are they going to just be kind of shrugged off?
I don't know. I don't know that it's going to be shrugged off. I doubt it will be, but I'm not sure I would characterize it as hiding behind, as if they're not feeling great about their business and they're just going to blame it on, tariff-related uncertainty. I think rightly so, they're going to say, we don't know. And I think what the overarching message from businesses has been, this goes back well before the Liberation Day tariff announcements, the Business Roundtable event that was held in Washington a few weeks ago. The overarching message was, we just need to know what the rules of the game are. What is the playing field? Are we playing on a soccer pitch, a football field? Is it a ping pong table? Is it a basketball court? Because then we can try to adapt and navigate around this. So I think the overarching message is going to be, we can't provide guidance because we don't know the rules of the game, either what the off ramps are or what policy definitively is going to look like in the next 1 month or 3 months or 1 year further out. And that probably means a continued constraint on any big picture investment decisions, whether it's CapEx or investment plans or M&A or IPO activity, et cetera.
Okay. All right. We have to leave it there. Ann Sonders, Chief Investment Strategist, Charles Schwab, thanks so much for sharing your insights.